Well, good morning and welcome everyone to the BetaShares Strengthen Your Core webinar. Thank you very much for everyone for taking the time to attend today. We'll get straight into it. Coming up is the all-important disclaimer slide, so please take a quick read of this, and obviously noting that any information provided today is very much general in nature. Fantastic. So in terms of the speakers today, we're very fortunate to have our Chief Economist and David Bassanese, who you can see in the wee box there already. Chamath De Silva, one of our portfolio managers, and one of our senior investment specialists in Cameron Gleeson, and myself, Chris Yates, as a Director of Advisor Business. Just before we do jump in, just letting everyone know, please write questions. You'll see on the right-hand side of that widget box, you can type in questions from CPD points or hopefully some relevant to some of the content that we've provided today as well. So the agenda is the US presidential election, which David will be covering now. After that, we'll be having a look at what is core and some key investment ideas, with which both Chamath and also Cam will be covering, and of course leaving some time at the end for some questions and answers. So with no further ado, over to you, David.
Thanks very much, Chris, and great to be with you all in what is I think going to be a pretty informative webinar. And my component today is, as Chris mentioned, to talk on the presidential election. Obviously a very hot topic at the moment. Markets are starting to take notice of this event that is looming, and just go into a bit of history of the a history of the election, how they've played in the past, and also what to sort of, things to fear or to look out for this time ahead. So firstly, this is just a chart that looks at the performance of the S&P 500 leading up to elections historically. So as you can see, in the 3 months heading into an election, typically markets have shown a bit of growth, but on average in the months leading up to an election, there's been weakness. So not all the time, but on average. So it just shows you, as you might expect, coming into a presidential election, there's markets take on some concern, price in some risk, and really sort of what we're seeing at the moment is certainly part and parcel of that risk. It's not the only thing going on in markets at the moment. Obviously, there's a debate about the COVID rates of COVID that are picking up in Europe in particular, with the lockdowns in the UK. And the rates are still going up in the US as well, but the election, and also the fact that Washington can't provide any stimulus at the moment, or seems incapable of providing more stimulus, is starting to concern markets. But the election is certainly in that at the moment. Just going to the next slide, and it just shows you again in a bit more detail. I'm looking at the more recent history, so that the previous slide talked about every election since 1900, but I guess more relevant is what's been happening certainly in modern history and so the last few decades, and just shows that on average markets have tended to perform better after elections than in leading up to it. And I've got some of the performances of the market in the few months before an election in the US, and what's tended to happen thereafter. Funnily enough, on this slide it shows that on average you've had a 4.5% gain in the 3 months before, but then a 7.5% gain afterwards. In the month before, it's probably a bit more, the differences are somewhat more stark. At in the 3 months, the period of share price performance is a bit weaker than that, and then the performance thereafter a bit stronger. So generally, what you're seeing is a relief rally generally post the election. Depending on who wins, of course, but not so much even depending on who wins. Just certainly these days, hope that it's a clean result and there's no disputes, and so the actual outcome is pretty well known fairly quickly. Now, I just wanted to highlight some scenarios where the elections have been particularly important, have played a particular role in recent history. So the 2000 election, for those, so this is the performance of the share market before and after the election. Zero there is on election day, and as you can see, in 2000, if you may recall, it was Gore versus Bush, and there was a debate about, you may laugh if you don't know this, but in some states they they vote by pushing a lever which pushes holes into a card, like an old punch card sort of system. And there was a debate about, whether or not the holes were sufficiently indentated, whether there was enough of a hole, and famously the term hanging chads was used. And so that was there was a dispute going on, and basically it went to this is the slide here, and it went to court, Supreme Court. Eventually Gore conceded; he didn't want to drag it out in the courts any further, and Bush became the winner of the election. And so that is the scenario this time. So the difference this time is a lot of postal votes, and so due to COVID, due to changes in policy that are allowing more people to vote via the post, there's going to be, the risk is that a lot of those postal votes are contested. And the issue is a lot of different states have different rules in terms of what is a legitimate postal vote. What day does the vote have to come in? What is the date of it being postmarked? All these sort of issues, really a potential can of worms in the aftermath of the election. And what set markets back overnight was Trump basically saying he needs to get a new Supreme Court justice, given one just recently died, because he thinks the result may well be decided by the Supreme Court. So he's already prepared for a legal fight, and I think that set markets are back overnight. So that is 2000. Now the other relevant one is 2008. And that was where Obama did win, but again, of course, it was in the middle of the GFC. The economy was weak, and as you can see, it was weakening in the lead up to the election, and it weakened in the aftermath of the election because the economy needed more stimulus, or the markets were hoping for more fiscal stimulus, and really we were in that dead zone where no one in Washington could make a decision until Obama got voted in. And then the last great fiscal package in early 09 was passed, and that was really helped market bottom, and it was onwards and upwards from there. So that we're actually seeing a combination of those two things, because Congress has failed to be able to agree on a stimulus package. Even the Fed is pleading for them to deliver another package. Some of the unemployment benefit provisions, for example, have been tapered somewhat. And given the battle now over a new Supreme Court nominee, any hope of a fiscal stimulus package this side of the election seems to have been greatly diminished. So we're potentially seeing a combination of both 2000 and 2008. Lack of stimulus at a time when the economy arguably needs it, plus a potentially legal stoush in the aftermath of the election. Now, in terms of the polling at the moment, just going to the next slide, I mean, this is the situation. I mean, at the moment, the markets do suggest Biden is ahead. So according to 538, which is a reputed, pollster, it polls all the different polls around the country, he's got about a 74% chance of winning, which seems pretty high. Betting markets got it a bit closer. It's something like 53 to 46. So betting markets see it as a closer result than some of the polls. Now, just go to the next slide. And the big worry here is that, of course, these polls were wrong last time. So this is what the polls are suggesting on the eve of the election with Clinton versus Trump. And, Clinton was seen as a 70% odds-on favourite to win. And obviously, she didn't win. And one of the concerns with these polls is that, many people that probably are planning to vote for Trump for whatever reason don't tell the vote when people ring up to ask for their vote. They kind of say, they haven't decided, or basically say they haven't decided, and don't want to admit or let people know that they plan on voting for Trump. So that is now some of the polls have made adjustments for that, and on that they say that Biden is still likely to win, but it's just an even closer call. The other big issue to watch, just going to the next slide, of course, is the Senate. And again, it's not only who wins the presidency, but who wins the Senate, because obviously if the Democrats win a clean sweep, Biden wins the presidency and the Democrats win the Senate, then it's open for the Democrats to sort of potentially increase corporate taxes again, regulate the tech sectors, things that I'll get into at the moment. But at the moment, the polls are suggesting also very close. But again, on balance, there's a chance that the Democrats will actually will win. So at the moment, the polls are suggesting it could be a clean sweep with Biden in power and the Democrats getting a majority in the Senate. Now, thinking about market scenarios, I'm going to just conclude with the final slide here. Going through market scenario, probably again, politics aside, in terms of purely what are good and bad scenarios for the market, a Trump win with the Republicans retaining control of the Senate would be the best case scenario, because it means the tax cuts, corporate tax cuts, won't be touched, and nor will there be major regulation of the tech sector. By contrast, a Biden win with the Democrats winning control of the Senate would be a worst case scenario, because, as I said, there is talk of bringing back some of those taxes that were cut previously, and then there'll be talk about antitrust provisions or regulation of the tech sector. So there are positives and negatives. I mean, the positive for Biden, of course, is that may reduce risks of trade tensions with China. We'll just have to wait and see. And if Trump wins, there is a risk of those trade tensions being escalated. I actually think they probably won't be. I think Trump was largely rattling the sabers with China for political reasons. As you can see, the deal he actually ended up doing with China was pretty weak eventually. So he may well ease back on those tensions once he's won, because he will never face re-election again. So just to sum up, we are going into a fairly difficult period for the markets, and there may well be the markets need to price in a bit more risk over the next few weeks. At the moment, the polls, I think, are pretty tight, and there could be a contested result thereafter. So really, that's something to be thinking about. But that's all I really have to say on the matter at the moment. And now I'll hand over to Cameron, who's going to go into the, I guess, the fuller part of the presentation, dealing with how to construct a core portfolio and some ideas in that regard. And I'll be back a bit later for questions.
Thanks, Dave. Yeah, so some uncertainty there with both the White House and the Senate in play. And one thing this really highlights is how important it is to ensure that the core of your client portfolios are strong and resilient for all sorts of market conditions. And that's what we're here to talk about today. So what do we mean by core, and what do we need from our core? Well, most of us approach investments from the framework of strategic asset allocation. So the first requirement is that our core holdings must deliver on the asset class exposures as defined by our target allocations. But beyond that, our starting assumption should be that we hope to hold core exposures over the long run, 5, 10, even 20 years. So we need low transaction costs, low turnover, and holdings that are going to be robust throughout the cycle. Clearly, we want strong long-term net of fee performance. And one thing I think we all recognize when trying to build a core portfolio is, the issues we face across all asset classes. The global economy is far more integrated than it once was. And we also see central bank stimulus has led to a very low rate environment. So we have growth assets that are now much more correlated, and some defensive exposures don't provide the same diversification value that we used to see from them. So we can no longer just look at each asset class bucket in isolation. We need to be much more efficient in how we combine these building blocks if we're to create a core holding which is going to be robust throughout the market cycle. This slide here shows an excerpt from the Global Risk Report, and this is compiled by some of the world's leading economists and actuaries. And every year they report on the top 10 global risks in terms of both likelihood and impact. And this particular report was published in January 2020, and we can see how low mention the infectious diseases rate on this report. What this obviously highlights is how poor we are as humans at forecasting the future. And from an investment perspective, timing the market is really difficult. If I'm applying that to thinking about our core, you should approach and you should have a strategic asset allocation which assumes that you don't have a crystal ball, that you can't predict the future. To look at growth assets and global equities in particular, means most asset allocators approach global equities either using an active manager or a broad market passive approach. The problem with active managers is that they are generally expensive. Broad market passive approaches also suffer because they will expose your clients to portfolios which on the whole have relatively poor fundamentals when you look at the overall mix of underlying companies. Both of these approaches have issues in terms of the diversification benefit they use, and we can see that in the drawdown chart there on the right. In shaded orange is the ASX 200 index, shaded grey the MSCI World, and we have a number of active manager styles also included. And we see that these all typically draw down together in periods of extreme market stress. The reason for this is that Australian equities have in fact they've doubled in terms of the level of correlation between Australian equities and global equities since the 80s. And so one of the key benefits of using global equities, that diversification benefit, is slowly being eroded. We've got to think about how we can use core global equity exposures to bring back some of that diversification benefit. And I'd suggest that the answer really is hiding in plain sight. That's high quality global companies. Quality companies have persistently high return on equity or high profitability. They have stable earnings, they have low leverage, strong cash flow generation. These are the types of companies that active managers have long talked about investing in. And previously, the only way to access these types of companies was through an active manager. But quality is not a new idea. What's changed is the broader availability of financial data that allows index providers to construct quality portfolios using the same filters which active managers have long relied on. In terms of showing what quality does in various market conditions, I like to look at the upside and downside capture ratios. And we have that here for the BetaShares Global Quality Leaders ETF, which tracks a quality index, which is the iStocks Global Qualities Index. So this ETF has the ticker code QLTY. So what this shows is that in months where the MSCI World rises, for every 1% rise or 100 basis points, QLTY, that ETF, has risen by 113 basis points. To look at the reverse scenario, when MSCI World falls by 100 basis points, QLTY has only worn the first 69 basis points of that drawdown. And this is that flight to quality phenomenon that we obviously hear about. We saw this in February, March of this year when QLTY only wore a fraction of the broader market drawdown. So to understand how or why quality can deliver this sort of result, you have to look under the hood. And it's all about strong, stable, profitable companies. Profitability in a company is measured by its return on equity. And here we can see the return on equity for the portfolio as a whole of the QLTY index. So across a long period of time, that return on equity is tracking between 30 and 25%, very stable, 3 to 4 times that of the broader market. So what that portfolio consists of is very strong, stable portfolio of companies. One of the key reasons for how quality delivers that long-term, consistently high return on equity is that quality companies have a very low level of leverage. Low leverage and the other factors that go to defining a quality company ensure that in periods of market uncertainty and drawdown, when cyclical companies falter, quality companies still maintain that high level of return on equity. Here we see the long-term performance of quality, and we've included a couple of quality indices, the iStocks Australian Quality Leaders Index in orange. We also see in light grey the MSCI World Index. We've also included MSCI World Quality Index. It's another quality index just for comparison purposes. And across all return periods, either quality index has dominated the broad market exposure. So not only has quality delivered against broad market exposure, but it's also done extremely well against active managers. This is Morningstar data showing the return results from unlisted global equity funds, which are typically or largely made up of active managers. So we can see here that some active managers do or have produced outperformance over these various return periods. But when you look through their return profile, where a lot of these active managers are actually delivering that outperformance is through exposure to quality. So we're able to do a return attribution of management returns. And I looked at one of the most widely used global equity managers here in Australia. And using factor analysis, you can break down their returns. And over the last 5 years, the return they've delivered over and above the MSCI World Index is actually as a result of exposure to quality. When you strip that out, the stock selection or the alpha from their stock selection is in fact negative or at best zero. So it really begs the question, if you can get exposure to quality through a low-cost passive approach, why pay an active manager 4 or 5 times that amount? And we obviously can see the ranking there of quality versus this peer group. Over 3 years, top 6%, top 4% over 5 years. And for the funds that have a time series over 10 years or returns over 10 years, it is the #1 ranked exposure. So I just want to quickly circle back on those key characteristics for core. I think we've presented the argument for why quality companies are what you want to hold over the cycle. But from a valuation perspective, they trade at a slight premium. You can see the PEs there. Slight premium, which I think is well justified by the type of companies and what they offer. In addition, if you're looking to access quality, you can do it through an active manager, but we've seen how a passive approach has outperformed net of fees over the long run. And the final point, this is really important, is that you want to hold a global equity exposure which has smaller drawdowns, which has lower correlation overall. And you can see the correlation there to the ASX 200. So you can see how that delivers on that front. Over to you, Chris.
Thanks, Cam. So look, if you're looking at a way of allocating to your global equities part of the portfolio in an easy, low-cost fashion that's going to give you an exposure to those quality companies, you can of course do that through our BetaShares Global Quality Leaders ETF, which trades under that ticker code of QLTY. It's giving you a diversified exposure across 150 companies ex-Australia that are defined as quality by those metrics that Cam covered. And at 35 basis points, it's very compelling and low cost as well. So Cam, I guess we've looked at large cap global equities. Maybe I guess having a look at some of the exciting parts of global equities and where we're going to drive growth from in terms of emerging markets.
Absolutely. So I think the point to make here is that emerging markets have changed, and that change is permanent. And investors really need to understand this when they're looking to build a core portfolio. We see here 3 of the top 10 largest companies in the world by market cap are emerging market technology companies. And if we look at the total market capitalization across the globe, equity market capitalization, emerging markets represents 12% of that. Just out of interest, Australia is only 3%. So if you're looking to build a diversified, globally diversified portfolio, you can't ignore emerging markets. The other key thing to note on emerging markets is how they've changed. So if you go back to 2010 or 20 years ago even, we saw that emerging markets were a tactical play. These economies were based on cheap manufacturing and commodity exporting. And so if you were looking to take a position in emerging markets as an investor, it was a short-term play on global growth, trade, commodity prices. Today, emerging market economies are a strategic exposure. These are economies that are consumer-led. They've got strong internal demand. They're long-term secular growth stories, particularly in Asia. And we can see that by the charts, the diagrams below. MSCI Emerging Market Index today is dominated by Asia, 80%. Half of the index is made up of technology-related sectors. The top five stocks in this index are all Asian technology stocks. And those 5 stocks have in fact driven 100% of the total return of the overall index over the last 2 years. This is just a sort of a bit of a snapshot of what's happening on the ground. And we see here in grey the US Thanksgiving weekend period total online sales. So this is the period that includes Black Friday and Cyber Monday. And that's grown strongly over time. In 2019 was at $30 billion US. Compare that to China's Singles Day, which is now more than double that. Yeah, in countries like in East Asian countries like China, we see that internet users are very comfortable transacting online, and they're very heavy users of technology like mobile payment services. However, if you look at the overall population and the penetration of internet in these countries, in China, internet penetration only sits at 65% of the total population. So it just speaks to the incredible tailwind these emerging market technology companies have. So, we've got long-term growth exposure, and that's key for core. Talking about valuations, one way to look at growth exposures and their valuations is to compare these Asian technology stocks with digital platforms, which are roughly equivalent peers in the US. So if we look at, for example, Alibaba versus Amazon, we can compare those PEs as a relative marker to where these Asian stocks sit in terms of that valuation. I think you'll agree, these are relatively compelling valuations for what is a strong growth story. From an Australian investor's perspective, we talked about this before, but adding diversification into your core is critical. That pie chart on the right shows the breakdown of the sole active Asia ex-Japan Technology and Internet Tigers Index. And we have an ETF, Asia, which tracks that. If we look at our Australian exposure, the breakdown of our Australian equities, we really don't want to be adding more of that, what I call old world EM. So we don't need more exposure to, for example, banking, like a South African bank. We don't need exposure to a Brazilian iron ore miner. We've already got that type of exposure at home. We need to look for sectors where the ASX is weak, and those technology-related sectors certainly are that. It's about building out your portfolio and complementing those weaknesses. And as a proof point, we see there how the correlation of that Asia index is, markedly smaller than what you get from the overall emerging market index. So again, real diversification benefits here. Sorry, Chris, I think you're on mute.
I am, mate. So, look, thanks, Cam. I guess if you are looking to allocate to emerging markets, but in a more precise way, and to the sectors within emerging markets that have those growth tailwinds to them, you can do that through our BetaShares Asian Technology Tigers ETF, which goes under the ticker code of ASIA. It's a low-cost way of getting a diversified exposure across 50 of the largest technology and retail and consumer retail companies by market cap at 67 basis points. So Cam, we'll let you have a break for a second, mate, and we'll pass it over to one of our senior portfolio managers in Chamath De Silva to cover fixed income. Thanks,
Great.
John.
Thanks, Chris. So asset allocation and portfolio construction is really key, and fixed income should be there in service of the overall portfolio and not viewed in isolation. Over the next few slides, I'll cover some of the flaws with the major benchmark indices and how you can think about approaching this very important asset class in order to strengthen your portfolios. So, although it's common for equity allocations to be in broad market cap weighted indices, we strongly caution against this approach for fixed income. And it's also very important to be clear about the type of fixed income exposures we want. And a good question to ask is, what type of growth assets do I already hold? So if we move on to the next slide, broad composite indices were really constructed more to capture the characteristics of the universe and not necessarily to be used as an investment exposure. Market cap weighting is liability weighting, which means issuers can effectively set their own weight in an index, which means it's issuer preferences, not asset allocation needs, that drive the risk profiles and outcomes of the index. Unstable risk profiles can result from both duration creep and segment creep, which I'll cover in the next slide. And finally, liability weighting can also result in very inefficient building blocks within the broader index. So on the next slide, the visual here shows how the broad Australian investment grade universe has evolved over time. And one key development has been the big lengthening of duration over the past 12 years, increasing from around 3 years during the GFC to over 6 years today. The main driver has been an increased footprint from the federal government, both in terms of the amount of issuance, but also the maturity profile of that issuance. Currently, federal and state government bonds account for over 80% of the broad universe, and given issuance needs over the next 12 months, that share will only increase further. Given that we have no control over what's issued within the universe, there are naturally many inefficient components within the broad composite. We'd argue that one inefficient building block is short-dated bonds, with around 25% of the benchmark in maturities under 3 years. Given the RBA's forward guidance and current yield curve control policies, they provide no pickup over cash and no roll down given the curve is flat, and they don't really have enough duration to produce any capital gains, even if front-end yields are able to fall further, which is debatable. So how do we address some of the flaws with these universe-based liability-weighted indices? Now, one option is to go with an all-in-one solution from an active manager. However, we need to be very careful with active manager selection. Overall, Australian fixed income active managers haven't exactly covered themselves with glory, with 81% underperforming the benchmark over the past 5 years, according to S&P's most recent SPIVA report. One manager that has proven to be an exception to the rule is Western Asset Management, which has delivered consistent outperformance while still focusing on the higher quality segments of the market. I'll now hand it over to Chris, who'll touch on our BNDS fund.
Yeah, thanks, Chum. And just as Chum noted there, it is very, very hard for these active managers to actually beat their relevant and efficient benchmarks in the AusBond composite. But one that has done this consistently and has been a top quartile active manager in the space is the Franklin Templeton Legg Mason Australian Bond Fund, which goes under that ticker code of BNDS, which is managed by the Western Asset team here in Australia. So what this provides asset allocators is one simple trade solution that's giving you allocation to your fixed income, but to a high conviction active manager. And you can see that long-term performance that the BNDS fund delivers over that relevant benchmark in terms of 3, 5, and 10 years. So just the next slide there, please. So the way you access this, again, is just by using that ticker code of BNDS and a very low cost at 42 basis points. Back to you, Chum.
Thanks, Chris. Now, another option is to go with a tailored solution that is tweaking the duration and credit exposures to suit your portfolio's specific needs. And this can be done by using any number of durational credit building blocks based on your needs for yield or income and your tolerance for interest rate duration, credit spread duration, as well as credit quality. And we have a range of duration and credit building blocks that you can mix and match in any way you see fit to deliver the outcomes that your portfolio needs. And on the next slide, so just an example of such a tailored approach. So let's say your portfolio has a relatively small equity allocation, but has a need for income, which means the portfolio arguably has a greater capacity to take on credit risk. In contrast, a portfolio with a large equity allocation and longer time horizon may actually benefit from longer dated government bonds. Over to you, Chris.
Thanks, Chum. So again, just taking that step back until we move on, it's looking at how has your fixed income delivered in your portfolios over the long term. So again, for fixed income, we're looking at exposures that can be held over that long-term basis. They are robust through all market cycles. Back to what Cameron said earlier, they've got to be compelling net of fees over that period and provide that stability to the portfolio. And again, it comes down to, I guess, what you're trying to do through that fixed income portion of the portfolio. Are you looking at capital stability? Is it around a level of yield you're trying to achieve, or is it providing some diversification away from your equity part of the portfolio? And as Chum said, we've given the building blocks to our investors to really sort of tailor their portfolios and define those outcomes. So one of them that can provide that in terms of yield and diversification is our BetaShares investment grade, Australian investment grade corporate bond ETF in CRED, giving you a diversified exposure across investment grade Australian corporate bonds at 25 basis points. And also the next one in terms of our Australian government bond ETF and AGVT, another diversification and safe haven asset allocation in terms of the fixed income, again giving you an easy diversified allocation into that part of the portfolio at 22 basis points. So I think, Chum, thank you very much for sharing your insights around that. We'll move back to Cam now. And Cam, can you just, I guess, move domestically and give us a bit of insights around Australian equities?
Yeah, great. Thanks, Chris. So we move to the next slide. This chart shows GDP growth over the last 28 years, and it just shows the incredible run that we've had up to now. What it's masked, though, is that our banking sector is actually a highly cyclical play, leveraged to the Australian economy. And our equity market as a whole is really structurally challenged for growth. Further to that, we've come to rely on a level of equity income in this country, which is just has not been seen in any other equity market. And given what's going on, that equity income is now challenged. So this presents some difficulties for asset allocators. And we see many different approaches for core Australian equities, obviously broad market exposure, but there are those clients that might be more suited to a growth style exposure. And we obviously have individuals with a real need for cash flow. So we'll touch on some of these solutions. Now, in terms of any discussion or decision about core, there's always a debate about active versus passive, and we certainly believe that passive adds value within core, but that there is space for both active and passive. With active, it's about ensuring that that manager and that fund is able to add net of fee value, and that can be in returns, in risk, or in other areas. SPIVA tracks the performance of active managers, and the results, some results are shown on this slide. Over 5 years, only 1 in 5 active managers in Australian equities has managed to outperform the benchmark. And the other thing that SPIVA shows us is that while active managers can have strong performance in 1 year, there's a really strong level of rotation where active managers will then fall from favour and produce poor performance the next year. And obviously, if you're rotating like this, it's very difficult to produce long-term outperformance over that sort of longer 5-year plus period, which is what you want from core. So, like I sort of had a look at this, and one way that a lot of investors will approach this problem is that they'll blend, say, 4 or 5 active managers to reduce, the impact of any single manager having underperformance. And I wanted to sort of test this approach and look at what SPIVA concludes and see whether I believe it stands up to the test. And I did that by looking at the 5 largest Australian equity funds from 5 years ago, that return period, and test their performance over the subsequent 5 years. The blue line in the chart shows the ASX 200 index, and the 5 yellow lines are each of those 5 funds. Well, firstly, we do see some dispersion, and secondly, you can only just make it out, but one of those funds did manage to outperform over 5 years, and not only just. So consistent with what SPIVA has told us. But looking at that from an investor's perspective, what does the blended outcome look like? Well, you can see here that the risk profile is actually quite similar to the overall index. And obviously you're going to have some results from active managers, particular tilts cancelling each other out. But if we look at the performance, and frankly, if we talk about long-term performance for core, I don't even care about the 1 month, 3 month, or even 1 year performance. What I care about really is that long-term 3 year, 5 year plus. We can see there's a significant drag on performance. What this inefficient blending of active managers is sometimes referred to, some people call it diversification. To talk through potential reasons for that, we do see a significant relationship if we look at Morningstar data here showing long-term performance versus fees. Poor performing funds typically are those with the higher fee levels, and this relationship is significant. So I put it to you that if your objective is to outperform the ASX 200 benchmark, rather than holding, for example, 4 or 5 active managers, you're more likely to get a positive outcome by holding on to 1 or 2 of those active managers that you've got most conviction in, but then switching the rest for a broad market passive approach, which is available at a very low price point.
Yeah, thanks, Cam. And again, if you are looking at the lowest cost exposure in Australia, we do have that through our BetaShares Australian 200 ETF, which goes under that ASX ticker code of A200. It's the lowest cost in the world at 7 basis points, and actually one of the fastest growing ETFs ever in Australia because of that. So an easy, efficient way of allocating to Aussie core. Now, Cam, if people are looking for a little bit more growth in terms of allocating to Aussie core, can you cover that as well, please?
Yeah, of course. So in building our asset allocation, we've got to reflect on the investor profile. So let's consider young accumulators. Like, how can we build an Australian equity core for these guys? Now, the problem for this cohort is that the top 20 stocks are concentrated in a few large banks, cyclical resources, a couple of supermarkets, and Telstra. Outside of CSL, these are largely mature, stable businesses with little long-term structural growth. And to go along with that issue, that top 20 names actually consists of, makes up roughly half of the overall ASX 200. So you've got a strong tilt or weighting to that part of the index. Young accumulators have a long time horizon, and they've got that critical need of building their asset base. And we're in a low growth world. So rather than holding the entire ASX 200, a more appropriate strategy maybe just to exclude those top 20 names. So hold stocks ranked 21 to 200. And if you look at what this provides you, you get a greater exposure to that mid-cap portion of the market, which has traditionally driven that more long-term growth. Those emerging leaders have a higher share of the overall portfolio and can really impact returns. And we see here on these two relative, the pie charts there, you can just see visually that you have a far more diversified sector exposure. And also you're obviously, you don't have that huge exposure to those highly correlated big four banks. Looking at these characteristics, I'd argue that beyond young accumulators, this approach has broad applicability. And we look at performance, it's outstripped performance of the broad market. It's also beaten other long-term performance from other sort of concentration reducing strategies like equal weight. So certainly one to look for.
Yeah, exactly right. And look, an easy way of allocating that into that better structural growth tilt to the portfolio, avoiding some of those top 20 stocks, which we know a lot of Aussie investors hold those directly for the dividend. So you can use this either as that growth tilt or even as a pure diversification play away from those SMSF 12 names that we see in portfolios. So you can do that again through the X20 fund. It trades under that ticker code at 25 basis points. I guess the other part to that, and I kind of touched on it, is a lot of investors are out there hunting yield and they do like those top 20 names. Is there, I guess, a better way that they can, I guess, tap into their income focus within their portfolio, Cam?
Yeah, absolutely. So, I mean, looking at this investor cohort, and we've talked about the need for cash flow, but, critically, we've got to be thinking about that downside risk. And equity income, in our views, really is an area, one of those pockets where active managers can add value, and really add value. So most passive equity income exposures, they're backwards looking in their portfolio construction. They don't really account for the sustainability of dividends going forward. And they'll have large sector concentrations at various points in the market cycle. The BetaShares Legg Mason Equity Income Fund is managed by Martin Curry, and it goes under the ticker code E-Inc. And Chris, I'll let you talk more about the strategy, but just to demonstrate the value an active manager can bring in for this particular segment of the market, we see these two waterfall charts, and these show the total dividend income from both the ASX 200 and E-Inc's portfolio, and they sort of show it broken out by stock. Where the E-Inc strategy really adds value is not only is the total level of income higher, and for investors that need income, that's obviously a good thing, but it's also the fact that the concentration of where that income is derived is far reduced. So for the ASX 200, half of the overall income is coming from 4 banks, 2 miners, and Telstra. Whereas in E-Inc's portfolio, there's larger exposures to names like AGL Energy, Medibank Private, JB Hi-Fi, so more diversification in terms of where that income's coming from. And this is just an example of an active manager adding value to a core holding by reducing the concentration issues that would otherwise exist in equity income.
Yeah, exactly right. And that's exactly why we see this used as that the allocation to those equity or income, focused clients. And again, it's just avoiding some of those inherent risks when you look at a passive backward looking exposure in the space. So what the Martin Currie team do, they have a huge emphasis on quality companies, but quality companies that have good, growing and sustainable dividend profiles within them. So it's very much on that forward-looking basis, not backwards looking. You can see there it's had great performance since inception, but also on a forward-looking yield basis, you're getting around 6.2% fully franked. So again, very compelling for those income-focused clients that need to allocate to Australian equities. And they can do this through the Equity Income Fund, which trades on the ASX under the EINC ticker code, and again at 85 basis points. So that's I guess equity income. I guess looking maybe into one of the sectors within portfolios that's overlooked or it's very costly to access traditionally, and that's Australian small caps.
Yeah, so thanks, Chris. So small caps obviously aren't going to usually be a large allocation within a strategic asset allocation, and some people won't include them at all. But they can deliver some of those characteristics we look for core in terms of equity diversification and also that long-term growth through these embryonic growing companies. The issue with small caps in this country is that if we look at the Small Ords Index, very pedestrian growth. The reason why that's occurring is for every market darling that you read about that's run up 500%, there's a long tail of companies that are really struggling and have perhaps had a drawdown of 80% or more. And this really draws down that overall index. So the question in this particular asset class becomes, how do you beat that index? And you can take an active approach if you like, try and pick those market darlings ahead of time. But we believe that a systematic approach, trying to identify and avoid those companies with undesirable investment characteristics. So if you like a quality filter to avoid the losers, screen out companies that are unprofitable, with high leverage, poor valuation and the like. We think this can result in strong outperformance, but means that we don't need to charge that high active fee that high management fee that active managers often do, and you get that compounding of the returns remaining in the investor's pocket.
Thanks, Cam. And again, if you're looking at using or finding an access point to allocate to small caps, again, avoiding just taking the whole market or paying, I guess, in a very expensive active manager's fee, which often those funds are closed out. You can do that through our BetaShares Australian Small Companies Select Fund under that ticker code of SMLL with a management fee of 32 basis points. And again, it's just an easy way that uses that systematic screening process to give you a quality tilt to that small cap sector. I guess now just on the final piece of, I guess, the asset allocation story that we're going through today, and that's looking at alternatives. Cam, can you just finally cover that for us, please?
Thanks, Chris. So gold is what we're going to talk about here. And gold is an alternative exposure which can really bolster the defensive characteristics of your portfolio. Gold performs in uncertain markets and has low correlation to both bonds and equities. Bond yields are at record lows, and look, in many countries they're in fact negative. So the relative cost of holding gold, the opportunity cost, has never been lower. In addition, some investors believe that the diversification benefits that fixed income can offer are perhaps reduced. And so globally we've seen massive inflows into gold ETFs throughout the year. Now, the Fed has signaled that it's likely to keep interest rates lower and allow inflation in their economy to run. And this, if it occurs, will lead to a further fall in real yields and a debasing of the US dollar. In a world where the US is debasing their currency or devaluing their currency, pumping more liquidity into the system, and we see inflation risks rising, gold acts as a currency of last resort. Gold is an insurance policy against experimental monetary policy by central banks. For Australian investors, what's really critical is to understand the relationship between gold and the Australian dollar. Strongest moves in gold tended to coincide with a debasement of the US dollar, or to flip it the other way for us Australians, tended to coincide with a strengthening in the Australian dollar. So these large extended rises in gold price over going back 40 years have generally been accompanied by that strengthening Australian dollar. And if you hold Australian dollar denominated gold or unhedged gold exposure, that has a real impact. I mean, if you've read the media over the last sort of 6 months, and they're talking about the gold price reaching new highs, they're always quoting US dollar gold. They don't talk about Australian dollar gold. So if you have a client who's got Australian dollar denominated gold, they're reading about appreciation in the US dollar gold price. If we take, for example, Q2, they will have read that gold prices increased by 12%. That Australian dollar position over that second quarter of 2020 was flat. The currency cancelled out any of the gains. So I'd encourage you, when you're looking at gold within your core portfolio, it's really critical to think about currency and what sort of exposure you want within that asset class.
Thanks, Cam. And again, we're giving you a couple of tools to allocate to gold through our ETF suite. You can, again, take a pure gold exposure currency hit through our BetaShares gold bullion ETF, which goes under that ticker code of QAU at 59 basis points. And again, what we find is, I guess, when people are allocating to gold within their portfolios, it is therefore, I guess, that safe haven asset. So we tend to, I guess, in our point of view, why would you take currency or a currency risk into that as well? And often the case when you're, I guess, doing that full asset allocation piece, you're often getting enough US dollar exposure through your global equities portion of the portfolio as well. The other option in terms of getting an exposure to gold is to actually get the exposure to the companies that are pulling it out of the ground. So we have the BetaShares Global Miners ETF, which again is currency hedged and trades under that ticker code of MNRS. And that's at a manager fee, including the expense recoveries at 57 basis points. And that's a diversified exposure across those large global mining companies, ex-Australia, which is important as well. So you're not getting any overlap here in Aussie. So just to summarize everything that's covered today, we're covering why you would allocate to core and really looking at your core portfolio allocations in terms of they need to be held and be held for the long run. They need to be able to be held through every market cycle, so robust through that and compelling in terms of that net of fee performance over that period. And again, they need to work well together in terms of enhancing the stability of the overall portfolio. So I'd like to thank Cam, David, and Chum for their time. We of course have time for questions as well. So I guess in terms of how can we help from a BetaShares point of view, of course, all our advisors have their dedicated contacts here that can provide them a lot of support around analytics and modeling, but also we have an efficient and effective way of being able to allocate to your core through our own dynamically adjusted SMA portfolios, which we can provide detailed quarterly reports on for engagements, not only for you as the advisor, but also for your clients, but also just as a guidance in terms of where we view asset allocation and comparing to where we are in that market cycle. Along with that, we have a heap of information on the website in terms of covering all the funds covered today, along with all the other funds that we have available as well. So please reach out to us and your dedicated account advisor at any time. So looking at questions now, there was a few as we went through the webinar, which I'll just get up now. So in terms of questions, I guess one for you, Cam, is looking at when comparing quality versus qual, what is the definition of quality for us in terms of the BetaShares QLTY ETF compared to qual, and why is there that difference?
Yeah, good question. Thanks, Chris. So if we look at the construction of the indices which qual and QLTY follow, there's a few key differences. Firstly, there's an additional input in terms of the QLTY index, which is to look at cash flow generation of these companies. But further to that, and I think what's most important is that the limits on how many stocks are included and the weights in terms of those stocks. So just briefly, qual has 300 stocks and a much higher cap per stock. The QLTY portfolio has a limit of 150 stocks, so you're getting the highest quality stocks from across the globe, so the top 150 versus 300. But because each of those stocks is capped at 2%, you actually get better diversification because of that capping. So they're the key differences. And if you look through, you can actually see the level of quality when you compare. We showed that level of debt to equity and that level of return on equity. They're far superior for the portfolio of QLTY versus Qual, just because of the way that portfolio is constructed.
Okay, perfect. And while we've got you there, Cam, as well, I guess the question is around, from one of the people on here, is around what's the consideration or the rationale for looking at Asia as a core allocation in terms of SAA to emerging markets compared to something like in terms of a thematic or a tilt to the portfolio?
Yeah, look, I mean, I think, sorry, I'm getting a bit of feedback there, but I think the key there is really, I mean, as we talked about, you know, these economies have changed, and I think people are still sort of thinking about that old world of taking a bet short term on global growth. For your core, you want that long-term structural growth, and wherever you can get that, that's great. You know, Asia is such a significant part of the overall global economy now, and because it has those characteristics of long-term growth, that's exactly what you want to add to your core.
Yeah, thanks, Cam. I guess another one here, I think this one would be probably for David. Are the structural forces which contained inflation over the past 10 years likely to persist for the foreseeable future? Aging demographics, surplus saving, nonsense inflation statistics, and shrinkflation, which is an interesting one. Historically high debt, declining velocity of money. I think you're on mute there, mate. You've done what I've done.
Okay, there you go. Can you? Yeah, great. Sorry, can you repeat that? That I was focused on trying to get that mute button off.
No worries. So, are the structural forces which contained inflation over the past 10 years likely to persist for the foreseeable future, noting aging demographics, surplus savings, shrinkflation, historically high debt, and declining velocity of money?
Very good question, and a short answer is yes. I think
long question, short answer. I like it.
I don't see much upside for inflation going forward. I think central banks are going to fail miserably in trying to achieve their inflation targets. That's why interest rates are going to stay lower for longer. And you know, until central banks change their mind on that, that's the sort of world we're living in, for good or bad.
Perfect. Well, look, that's all the questions that we have so far. Again, thank you all in terms of Cameron, Chum, and David for your time. And of course, thank you to all the people who attended the webinar. This webinar, of course, has been recorded. So if you need to go back over anything, it will be getting sent out to you after this. But thanks again for attending, and we really appreciate your time.
Bye, everyone.
Thank you.